All right, welcome back, everyone. So you've got your one rental property. It's cash flowing, everything's wonderful, and you're wondering, how do I scale from this single property to a real portfolio of 10? Let me tell you, going from 1 to 10 is more than just purchasing 9 other houses. It's a whole transformation. You have to stop thinking like the hands-on technician, the person who fixes the toilet and screens the tenants, and start thinking like the CEO of your own real estate empire. Your job shifts from doing the work to managing the systems, the capital, and the teams that do the work for you. That's the fundamental shift we're going to break down today. So what does it actually take to scale? Think of your growth as being supported by 4 pillars. If one of them is broken, it creates a bottleneck that will bring your expansion to a dead stop. Number 1, you have capital acquisition. This is all about your capital strategies, how you fuel your next deal. Second is structuring legally. This is your protection, using things like LLCs so that a lawsuit of one property won't destroy your life's work. Third is delegating operations. This is where you no longer become the property manager and you build a team with systematized systems. And finally, fourth is portfolio strategy. This is your big picture plan for optimizing your assets. You need to be actively constructing all 4 of these simultaneously. You can't have your sights on acquiring deals and not a law, or you're constructing on unfirm ground. Now, the journey from 1 to 10 is not a linear process. It occurs in 3 phases, and each phase focuses on something different. During phase 1, in properties 1 through 3, you're accelerating capital. Your ultimate goal here is to master a strategy called BRRRR. That is, buy, rehab, rent, refinance, repeat. The secret here is recycling funds. You put your initial capital in, you drive appreciation, you take that money out, and you reinvest it in the next property. You're building a financial machine. Then, phase 2, houses 4 to 7, you run into a brick wall with bank financing. So this phase is systemization and breaking through barriers. You'll set up LLCs, you'll put your professional staff together, and you'll make that critical change to a new type of loan that's referred to as a DSCR loan, which qualifies the property on its income, not your income. Finally, on phase 3, for properties 8 and higher, you start optimizing and leveraging your size. This is where you can move into small apartment buildings for better economies of scale and use advanced tax strategies like 1031 exchanges to stall your capital gains and get your money to work harder. Let's dive further into that BRRRR strategy, because this is the engine that accelerates you from 0 to 60. BRRRR equals: buy a discounted house with great potential, rehab it to force appreciation through intentional improvements, rent it up to a quality tenant at market rent. Then you refinance it on a fresh, long-term loan at the higher after-repair value. This is the most critical step, the cash-out refinance. You pull your initial investment money out, and then you do it all again. Instead of your money being tied up in one piece of property, it's being cycled constantly to buy the next one. BRRRR does sound great, but it's got 2 significant areas of failure you just have to plan for. The first is the appraisal. Your entire plan is destroyed if the property won't appraise for the dollar amount that you need it to after rehab. If you go over budget on the work, or the appraiser is one of the conservative types, you might not see all your cash out. That equity is trapped, and your growth momentum is halted. The second obstacle is seasoning periods imposed by lenders. You can't do a cash-out refi in most situations immediately. They'll wait 6 to 12 months since the rehab was completed. This regulates your speed. Due to this, you can't run your entire business on a shoestring. You need to have a fine cushion of capital, a rehab reserve, to cover these deficiencies and timing lapses so you can keep progressing on multiple projects. Alright, so you're a BRRRR master and you're soaring along, right up until the wall. That's the traditional financing limit. There are 2 things to this. First, there's an absolute cap. Federal law dictates that you can only have up to 10 traditional mortgages in your name, including your home. So technically, you can only have 9 rental properties using traditional financing. But in all seriousness, you'll be shut down sooner because of your debt-to-income ratio, or DTI. When you get to your fourth, fifth, or sixth piece of property, the amount of debt on your personal credit report will cause your DTI over the average lender's cutoff of somewhere around 45%. So although you've got cash-flowing properties, the bank will just say no. This is the greatest obstacle to new investors. Well, how do you break through that ceiling? You make a strategic pivot to DSCR loans. DSCR equals debt service coverage ratio. This is a complete game changer. With a conventional loan, the bank is asking, can you, the borrower, afford this payment? With a DSCR loan, the lender is asking, can the building pay for itself? They take the gross rent each month and divide by the total monthly mortgage payment. That's interest, principal, taxes, and insurance. They're looking for a ratio. And generally, they want to achieve a DSCR of 1.2 or better. This translates to rent of 1.2 times mortgage payment, proving the property pays for itself with cushion. This completely ignores your personal DTI. Your focus shifts away from your W-2 income and towards the net operating income of the asset. Your job now is to find and arrange deals with solid, supportable cash flow. Let's make that very clear with a quick comparison. Conventional loans are fine for your first few properties. They have low rates, but they come with that strict personal DTI requirement and that 10-property ceiling. DSCR loans, which you take from property 5 and onwards, are unlimited. They are qualified on the cash flow of the property, they have minimal impact on your own DTI, and they concentrate on that 1.2 to 1.25 ratio. But with scale, there's a cost. You're paying more in interest and fees, and these loans have shorter terms, like 5 or 7-year balloon payments. You're paying a premium to scale rapidly. As you get more advanced, other commercial loan products are out there. For example, portfolio loans are retained by the local bank that originates them, so they can make more lenient underwriting for investors who own a lot of properties or out-of-the-ordinary situations. And then there are blanket mortgages, which are just enormously strong. Here is one loan that finances several properties simultaneously. It streamlines your administration, lowers your closing costs, and is practically indispensable when you want to cluster properties together, particularly if you're going into multifamily investing. Now we can talk about ensuring all you're gaining. Having 10 properties and having them all in your own name is just a crazy amount of risk or a potentiality when you have 10 properties. The likelihood of a big liability event, a suit by a tenant, an injury to someone on one of your properties, an environmental issue is not if, but when. Without legal segregation, the one lawsuit against one asset could expose your entire personal net worth to risk. Your personal home, your savings, your kids' college funds, everything. You can't negotiate on this. You need to build a legal moat around your assets. The primary vehicle for building that moat is the limited liability company, or LLC. An LLC sets a corporate veil which separates your business liabilities from your personal assets. In case something happens to one property, your personal assets are safe. LLCs are wonderful because of tax flexibility, too. They're pass-through entities by default, so your profits and losses just get passed on to your individual tax return, no double taxation. As you get more advanced, you can even elect to be taxed as an S-corp to avoid self-employment taxes. For owning multiple properties, you have two main choices. You can have one LLC per property for maximum liability segmentation, or, in some states, you can use a series LLC, a similar master LLC with distinct, separated compartments for each property. More administratively efficient. And another vital sidebar, commercial banks and DSCR lenders prefer to lend to LLCs rather than to individuals. So having this setup is crucial for your financing too. Just to hammer this home, let's contrast the choices. Holding properties as an individual or sole proprietorship doesn't afford any protection. It's unscalable and high risk. An LLC offers strong personal asset protection and tax flexibility, and it's ideal for portfolio growth. A C corporation does offer protection, but at the expense of a complex setup and double taxation. So it's really only useful if you're having large outside investors. The larger your portfolio gets, the larger a concern taxes become. One of your best tools is the 1031 exchange. It allows you to sell an investment property, defer all of the capital gain taxes, and invest the entire proceeds into another like-kind investment property. The process is strict. Once you sell, you have 45 days to acquire replacement properties and 180 days in total to close on one of them. A replacement property must be at least as valuable, and you generally need to retain or grow the debt. But this is the best tip you will ever get on this. Do not allow the tax tail to wag the investment dog. The 1031 is a handy tool, but your best option always has to be enhancing your portfolio. To generate greater cash flow, a better market, a better asset. If your only alternative property that you can find in time happens to be an unfavorable deal, it is best to just pay the tax and hold on for a better opportunity. Don't ever buy a bad property just to avoid a tax payment. All right, operations again. As your portfolio surpasses 4 properties, you need to make one of the most important mental switches of your entire career. You are going to have to fire yourself as the property manager. The day-to-day will consume all the time you need to do the high-level CEO tasks, deal hunting, deal financement, and strategic planning. Your inner circle is officially your lifeline. You need an understanding real estate agent who understands investments. Quality contractors, a professional property management company, a real estate specialist CPA, and a mortgage broker familiar with DSCR and portfolio loans. Commissions to a professional property manager are not a luxury. They're a growth cost of necessity. You have to factor this into your metrics at the get-go. Standard fees are 8% to 12% of the gross rent, plus other potential fees. Here's the twist, though your property manager's performance is a pure financial lever for you. Their top priority, in my opinion, is tenant retention. A happy tenant who signs a second lease saves you thousands of turnover cost, lost rent, and advertising fees. Every time a tenant leaves, it costs you money, and that lost income actually lowers your net operating income directly. Lower NOI hurts your ability to qualify for those future DSCR loans. So operational efficiency isn't about less headache, it's a financial imperative for your growth. To have that level of quality of service on all of your properties, you need standard operating procedures, SOPs. These are simple checklists and procedures for everything. How you get a tenant on board, how you handle a maintenance request, how you collect rent. It keeps things routine, keeps the little problems from turning into big ones. And on your initial 10 properties, I strongly recommend geographic concentration. You're not wondering how to manage properties scattered all over several cities or states. You focus in one location. You make it all simple. Your contractors are close by, where property manager knows the marketplace and maintenance gets resolved immediately. You become a master of that very specialized marketplace, and that is a huge advantage. When you hit that 10 property milestone, it's time to look ahead to your next strategic move, the transition from single-family residences to multifamily structures, which are buildings with 5 or more units. The benefits are staggering. Economies of scale. Handling 10 units under one roof means one mortgage, one insurance policy, one roof, and simpler upkeep. Your per-unit costs plummet. You get more consistent cash flow. If you lose one tenant on a 10-unit building, you lost only 10% of your income, not 100% like with a single-family home. And most notably, you get forced appreciation. Unlike single-family homes, where they value them off what other similar houses sold for, apartments are valued off their net operating income. You can really move the value of your building in the positive direction by increasing rents, reducing expenses, and maximizing operations. Let's look at the side-by-side. Single-family rentals have poor economies of scale and high vacancy risk. Appreciation is mostly passive, relying on the market. Multifamily has excellent economies of scale, low vacancy risk, and forced active appreciation. You control the value growth. You finance it with commercial blanket mortgages, and the tax advantages through depreciation and cost segregation are significantly turbocharged. Here is a solid advanced move. You can combine the 1031 exchange we've talked about previously with your multifamily transition. Consider it this way. You're selling off your first 3 highly appreciated single-family homes. You're using a 1031 exchange to defer all of the capital gains tax. And you're taking the entire stack of cash and you're making that as a down payment on a small apartment building. Not only are you deferring taxes, but you're consolidating a ton of management hassles into a single successful asset and keeping those huge economies of scale in one transaction. That's how you truly level up your portfolio. So it's not about stacking 10 deeds. It's about substituting personal constraints with scalable professional processes. You've evolved from conventional loans to DSCR lending. You've protected your assets with LLCs. You've outsourced operations to a professional team. This 10 property marker is your benchmark. It shows you have operational maturity. You have systems, know-how, and access established. This is the foundation for true institutional development, for overseeing dozens or even hundreds of units. Your maturation from a hands-on technician to a strategic CEO is done. Now you're building enduring wealth. If you like this video and wish to proceed with your real estate learning, then subscribe to the channel and hit the bell so that you can know what's in store next. To keep your momentum rolling, I've chosen another video for you that will help you in your investing journey. You'll see it right here on the screen. Just click it and go ahead and learn some more. Thanks for watching. I'll see you in the next one.